Welcome back. In this video, we'll be solving another example question in which we'll be required to prepare the T account of provision for depreciation, its double entries, and that too for multiple years, right? So let's begin. The question says a company starts in business on 1st January 2018, very good, and the financial year end being 31st December, right? Information related to equipment is as follows, okay? So for the year 2018, this business bought one item of equipment costing $800 on 1st of January, right? So we have the purchase date, we have the cost, and we have the number of items, and that is 1 in the year 2018. Then next 2019, on 1st July, two items costing $1200 each, right? So this means that the total cost would be $1200 multiplied by 2, $2400 is the total cost of these two items, okay. And then in the same year, again on 1st October, one item costing $600, right. Then no purchases in the year 2020, and then the business has purchased an asset costing $1400 on 1st April 2021, right. So dates, the purchase dates, the purchase months, the costs, very important information is given to us over here. Then the policy. Depreciation is over 10 years using the straight line method, okay. So this is the useful life, and because the useful life is given, so the method is straight line method, and equipment being depreciated for the proportion of the year that they are owned. So you remember in the last video we solved an example in which reducing balance method was given and the policy was full year policy. So in this question we have straight line method and monthly basis policy. Okay, so this is good. The requirements. The requirement is part A, to prepare the equipment account, then provision for depreciation of equipment account and SOFP extract for each of these years, right. Very good. Okay, so let's begin with the first requirement, and that is to prepare the equipment account, right. So first year is year 2018. We know that there is no brought down given in this question, so we will directly start with the purchases of these equipments. So this equipment is being purchased on 1st of January costing $800. So January 1st, let's assume that it is purchased through cash, or it can be bank as well. The value is $800, right. No other purchases in the same year, so we will just balance this account now. So the year end is December 31st. Balance carried down $800. Okay, so if there is just one entry in the account for a particular year, you can just finish it over here. You don't again have to write the totals, right. Okay, so next year 2019, before writing the new purchases of the equipment, we will first write the balance brought down. January 1st balance brought down, and that is $800, right. Next year, year 2019, 1st July, two items costing $1200 each, right. So 1st July, 2400. If you want, you can write these two items separately as well, but since depreciation calculated on these assets will be same as these are being purchased on the same date, so it doesn't make much of a difference, okay. Then next purchase is on 1st of October amounting to $600. So October 1st cash, right. No other purchases in the same year. We are done with 2018, we are done with 2019 as well. Now we just have to balance this account. Balance carried down of equipment at 31st December 2019 is 3800, right. Now you can write the totals, 3800, 3800. Now year 2020. Please don't make this mistake that just because 2020 information, the new purchases related to 2020 are not given because there are no purchases in that year. So it does not mean that you just skip your account from 2019 to 2021. No, right. We'll write the balances brought down and the balances carried down for year 2020 as well. So January 1st balance brought down is 3800. And since there are no purchases, so you just have to write the balance carried down on December 31st. Why we cannot skip this part, why we cannot skip this year is because the asset was there in the business in this year the company was using this asset, it was benefiting from this asset. So, that is why even if there are no purchases, the asset will still be depreciated in this year, right. The old ones will still be depreciated in this year. And again, since there are no more entries, more than one entry on both the sides, so we can just finish this account over here as well. Now, last year is 2021, January 1st, again the balance brought down 3800, and new purchase is on 1st April $1400. So, $1400 on April 1st, right. Now, balance carried down will be 1400 plus 3800, and that will be $5200, right. So, 5200 on both the sides. Okay. Now, should I just stop over here this equipment T account? No, I know that even if the information was given till year 2021, I still have to bring down the balance for the next year, that is year 2022, and that would be 5200, right. So, this is how we prepare our non-current asset account, which is at cost, right, because all the costs are recorded in this account. We do not record the net book values in this account, that is after the subtraction of depreciation from the cost, right. So, we are done with part A. Now, let us move to part B, and that is provision for depreciation of equipment. Okay, so first year is year 2018, again no balance brought down is given. So, what will be the two entries recorded for this year, that is 2018. First entry will be the income statement, that is the current year depreciation charged on the equipment, and we will be calculating that, and lastly the balance carried down, that is the accumulated depreciation. So, in year 2018, first of all the policy is straight line method and 10 years useful life proportion of the year that they are owned. Okay. Okay, so since we have constructed the non-current asset account, we don't again have to go back to the question to look for the purchase dates and the costs and the years. No, you just have to know the policy, straight line, and the number of years, that is the useful life, and they are being depreciated using the monthly basis policy. So, just use this non-current asset account to calculate depreciation on every non-current asset. So, in year 2018, first asset is being purchased, and that is on the first date of the financial year. So, the depreciation charge will be for full 12 months, okay, for full 12 months. So, how will we charge this? Cost divided by the useful life. Okay, so this is my working area. I know that if I am following the straight line method, then how do we calculate depreciation if residual value of the asset is not given? So, depreciation will be calculated by cost divided by the useful life, right, estimated useful life. The first year is 2018, right. Let us name it equipment 1. So, the cost is 800 divided by the number of years, and there will be no proration because it is being purchased on the first date of the financial year. So, depreciation on this equipment will be $80, right. So, 80 will be recorded in the provision for depreciation account as well, 80, and 80 as balance carried down as well, right. Now, let us move to 2019. First of all, don't forget to write the balance brought down. So, January 1st balance brought down $80, right. Now, next entries will be December, on December 31, again the income statement and the accumulated depreciation, and this time the accumulated depreciation will consist of the balance brought down as well, right. So, you have to add the balance brought down in the current year depreciation. Okay, so now year is 2019. Before moving to the new assets that are being purchased in this year, let us first charge depreciation on the old one, right. So, equipment 1, again 800 divided by 10. This is the benefit of straight line method, that you don't have to do the calculation again and again. So again the same depreciation will be charged on this asset in the year 2019, right. Now let's move to equipment number 2. This is being purchased on, we are done with this asset, right. Now this asset is being purchased on July 1st, right. So for how many months? July, August, September, October, November, December. For 6 months this asset remained in the business in the year 2019, and the third one is being purchased on October 1st. So October, November, December for 3 months. This is my equipment number 2, this is my equipment number 3, right. So 2400 is the cost of these two equipments. So okay, let's just change the color now. 2400 cost divided by the estimated useful life 10 years, but now this time I'll have to depreciate it according to the number of months that it was owned in the business. So 6 months divided by 12 months will give me a depreciation for just 6 months, and that would be $120 on both of these assets, right, on both of these assets. If you are calculating depreciation separately, then it would be 1200 divided by 10 multiplied by 6 upon 12, which will give you a depreciation on one of these assets 60, and then the same one for second as well. So the same value will come $120. Okay. Then equipment number 3. Equipment number 3. This is at a cost of $600 being purchased just 3 months before the year end. So 600 divided by 10 multiplied by 3 upon 12 months, it will be $15, right. So this is how we charge depreciation separately on each of these assets if we are following the monthly basis policy, right, especially in the year of purchase, because then you have to depreciate it according to the number of months. So what is the total depreciation charge in the current year on these 3 assets in the year 2019? That is 80 plus 120 plus 15, and that is $215. Where should I write this value? As my income statement figure or as my balance CD figure? This is my income statement figure, right. With this amount you will make the double entry, right. What will be the double entry for 2019? 2019 income statement debit, right, and provision for depreciation being a contra asset account credit with 215. So this is my current year depreciation on all of these assets, asset number 1, 2 and 3. This means that my accumulated depreciation at year end is 215 plus 80, and that will be 295, right. Now the total is also 295. Okay. Next year, year 2020, again we cannot skip the depreciation. The asset will be depreciated in the next year as well, even if we are not purchasing any new asset, but still the old ones will be depreciated. So balance brought down. So first 295, then the next entries will be the income statement value of course, and on December 31st the balance carried down. Now what is happening in 2020? Nothing much, right. So the balance brought down is 3800 and the balance carried down is also 3800. Now what do you think? Should I again do the calculation for each of these assets separately? That is, should I first of all write for equipment 1, then equipment 2, then equipment 3, divide by the number of years, its cost divided by the number of years? Should I do that or should I not? So I can if I want to, okay, but since I am following the straight line method, so we know that under straight line method the depreciation charge on the non-current assets remains the same each year, right. The only difference comes in the year of purchase and in the year of disposal, and for that we have done the calculation for each of these assets, right. For equipment 1 2018 and for equipment 2 and 3 for in 2019 we have done that. Now we know that since these 3 assets were there in the business for full 12 months, we now don't have to prorate it according to the number of months. So why go through the hassle of calculating depreciation separately on each of these assets if we know that the useful life is also same? So then now what we can do is we will take the cost of each of these assets, that is equipment 1, equipment 2 and equipment 3, and then divided by the estimated useful life. So the cost is 800 plus 2400 plus 600 and then divided by the number of years, and that is 10. So the total cost of these three assets is 3800 divided by 10 would give me a depreciation for current year only on all of these three assets amounting to $380. If you want to check the depreciation on each of these assets separately, so we can do that as well. Asset number 1, that is equipment number 1, 800 divided by 10 will give me a depreciation of 80, right. Then equipment number 2, 2400 divided by 10 is equals to 240, and for equipment number 3 as well, 600 divided by 10 is equals to 60. So the total of these three will also be 380, which is the same as this one. But again, why have I followed this shortcut and not the long calculation? This is only because there was first of all no proration in this year, right, first thing. Then secondly, if there had been new purchase of assets of equipment, so I would have to calculate or charge depreciation on that asset separately according to the number of months, because we were following the monthly basis policy, right. And thirdly, since we are following the straight line method, so we know that in straight line method you just have to take the cost and not the net book value. So the cost remains the same in every year, so you just have to take the cost and then divide by the number of years. And since in this example the useful life was also same, so that also benefited us in calculating depreciation in a easier way, right. So my current year depreciation for year 2020 is 380. This means that my accumulated depreciation will be 380 plus 295, and that will be 675, right. What will be the double entry for year 2020? Income statement debit, provision for depreciation credit with value 675 or 380? 380 only, right. Why 380? Only current year depreciation goes in your income statement. The accumulated depreciation, all these accumulated will go in your statement of financial position. Okay. Now we are standing in the last year, and that is year 2021. So again, what will be recorded in this year in the provision for depreciation account? Again the same things. That is the balance brought down coming from last year, and the current year depreciation which will go in the income statement, and lastly the balance CD figure, that is your accumulated depreciation. Okay. So what is happening in 2021? We have the balance brought down 3800, that is for all of these three assets, and we are purchasing the new one on April 1st, that is how many months before the year end? April, May, June, July, August, September, October, November, December, 9 months before the year end. So depreciation will be charged on these 9 months only. Okay, so now again it's up to you that if you have the time, you can calculate depreciation on all of these first three assets separately, but I don't think that you should, because if you have the straight line method of depreciation, then use it to save your time. So depreciation on equipment 1, equipment 2 and equipment 3 will again be $380, right. That is how we calculated in the year 2020, right. And you just have to calculate depreciation on equipment number 4, that is for 9 months, the cost being 1400 divided by 10 years and multiplied with 9 divided by 12 months, which will give you a depreciation of 105, right. This is the depreciation charge on the new asset being purchased just 9 months before the year end, right. So what will be the total depreciation charge in this year? 380 plus 105 would be 485. Where will you take this figure? in the provision for depreciation account on the debit or credit side? On the credit side, right? And what will be the double entry to record depreciation in 2021? Income statement debit 485 and provision for depreciation credit 485, right? So let's write that down in the T account as well. The balance brought down was 675. Current year depreciation charge is 485, which means that our balance carried down figure is 1160. 1160 will go in your statement of financial position as an accumulated depreciation figure for 2021. Lastly, we just have to bring down the balance for the next year, that is 2022. Balance brought down 1160, right? So this is how we have prepared our provision for depreciation equipment account for each of these years, 18, 19, 20, 21 and 22. Balance brought down as well. Now we are left with just the third requirement, and that is SOFP extracts for each of these years. I have already told you that how do we prepare the SOFP extracts. Do we have to look at the question again and again? No. Do we have to do some sort of calculation again? No. We just have to see the balances carried down in both of these accounts, the cost account as well as the depreciation account, because we know that all the balances carried down become part of our statement of financial position, right? So let's start with that part. SOFP extract. First year is year 2018. Non-current assets, equipment at cost. Okay, so year 2018, what is the balance carried down? $800. So 800 is the cost of the equipment in 2018. Then we know that we have to subtract the provision for depreciation, so less provision for depreciation, and that will be provision for depreciation balance carried down $80, right, on the opposite side, debit side. So less $80 will give me a net book value of 720. This is the first format that you can use to make your statement of financial position extract, right? Now let's learn another format which can also be used for next year 2019, right? Now this format is used in long questions in which you are required to prepare the income statement and the statement of financial position when you are given with a list of balances and a number of adjustments as well, right? So what is that format? You write the cost in first column, then you write the accumulated depreciation in the next column, and in the third column we write the net book value. Now again we have the non-current assets, and that is equipment. Now this is the horizontal format of calculating your net book value, right, of making your extract. So the balance carried down figure in 2019 is 3800 because we purchased 2 new assets in that year. So cost is 3800, right? In the first column you write the cost, balance CD figure. This was also the cost, but this was written like this. Then in the second column we write the accumulated depreciation for that year, and that is 295, and then 3800 less 295 will give me a figure of 3505. You don't have to write the brackets as well, because this is implied that if you are following this format, so of course you will be subtracting the depreciation from the cost, and then you will be arriving at your net book value. So this is the second format. There is one more format which you can also use if you are given with multiple years, and that we will be using for year 2020 and year 2021. So how do we write this? Non-current assets again, and then we know that we have equipment at cost, and we have to subtract the provision for depreciation from the cost, right? So in 2020 we will write, 2020 is of course balance CD figure for equipment, and that is 3800, and for 2021 it is 5200. So let's write that down over here, 3800, and for the year 2021 it is 5200 because we purchased one more asset in that year, right? Then for provision for depreciation, these are the two balances for these 2 years, 675 and 1160. So less 675 and less 1160 will give us a net book value of, for both of these years, for 2020 it will be 3125, and for 2021 it will be 4040, right? So if you have multiple years, you can follow this format as well. For instance, 2018 column, 2019, 2020 and 2021, you just have to write this information, that is the cost and the provision for depreciation, one time and not again and again for each of the years, right? Or you can also follow this format, or it's up to you. If you have so much time, then you can follow this format as well for making the extract for each of the years. So this is how we do the workings, this is how we make the T accounts, this is how we make the double entries if we are given with any such question. That's it for this video. See you in the next one.